Welcome to Motley Fool Money. Thanks for being here. I'm your host, Chris Hill. Joining me in studio this week from Motley Fool Inside Value, Joe Magyer. From Motley Fool Income Investor, James Early. And from $1 Million Portfolio, Charly Travers. Good to see you guys.
Howdy.
Good to see you, Chris.
We have got some big numbers in the smartphone industry. We will head to Sin City for a report from the Consumer Electronics Show. And as always, we've got a few stocks on our radar to share. But we begin this week with earnings season, which officially kicked off. Wells Fargo was the first big Wall Street bank to report. Fourth quarter profit up 24% due to gains in the mortgage division. Joe, I know this is a bank that you watch closely. The headline looks good, and yet the shares were down a little bit on the news. What's going on?
Yeah, well, there are a lot of moving parts to any big bank, including Wells, and the market right now is concerned that net interest margins are falling, and so interest rates are low, and the spreads that banks make on loans are very lean right now. Now, that said, the plus side is that they're writing a lot more mortgages, so a lot of people have gone out and taken advantage of that. Now, that's starting to fall as rates are starting to tick back up. A lot of people have already refied. Charlie's desperately trying to get his refi done.
5 months and counting.
Yeah, but ultimately, I think the stock is pretty cheap, and that a lot of these concerns are priced in at this point. And there's kind of a seesaw with rates. So when interest rates do come back up, the downside is there'll be fewer mortgage applications into processing, but the flip side is interest margins will go up. So there is kind of a natural built-in hedge in the business, and I think the market's probably overthinking this one.
James, what do you think?
Joe says it well, as he usually does. When rates are low, banks are supposed to be making up for the interest margin issue on volume. In other words, they should have a lot of loans. Now, if you're not an impassioned bank follower like we are, know that banks basically pay out money at the short-term rate and receive money from the loans they make at the long-term rate. So when those rates don't leave a big spread, in other words, the rates are fairly similar, they don't make much money, and particularly after Dodd-Frank legislation removed or starting to remove all these obnoxious fees that banks were relying on. In fact, they were making the majority of their money from these fees, but now these are going away. Net interest margin is now more important.
Charlie, do I have this right, that Wells Fargo is doing so much refinancing business that your refi is taking
Apparently,
5 months?
The backlog must be huge. Or they're, just playing Xbox all day. I don't know.
Joe, you got to feel good about the fact that Charlie's refi is taking that long because, that means
as a Wells Fargo shareholder, I want to say we do value your business.
Next week, Wednesday and Thursday, we're going to see most of the other big banks reporting. To what extent, if any, can we sort of extrapolate out the results of Wells Fargo into expectations for the other big banks?
Yeah, you can on certain spots. I think you're going to see a slowdown in mortgage originations, which is going to hurt like your JP Morgans, which are pretty active there. But net charge-offs are still really low, which is a good sign for all the banks. And ultimately, I think the numbers are overall favorable. I do think you're going to see the big story being net interest margins staying low, and that's where analysts are going to be concerned over the next few quarters.
Shares of Nokia were up more than 15% on Thursday after the company pre-announced quarterly earnings. 4.4 million Lumia phones sold. And Charlie, while that is not necessarily a huge number in the smartphone industry, it was certainly more than people were expecting.
And it's more than the company itself was even expecting, Chris. When Windows Phone 8 came out in November, I think everybody was holding their breath. This is a completely unproven ecosystem. Nokia bet their entire company on it. And so far, it looks like there's signs that this bet is paying off. And that's a good thing because if it didn't, it'd be game over for them. But we have to put this in a little bit of context here. The 4.4 million Lumias they sold, while that's a good start for Nokia, it's still a fraction of what the Samsung Galaxy S3 sells and an iPhone sell in a given quarter. So I would not say that Nokia is out of the woods by any stretch of the imagination, but they have a foundation to build upon as they go through this year.
Yeah, Joe, I was going to say Samsung earlier in the week shared that they sold 62 million phones in the
Always
quarter.
one-upping people.
To what extent do you think that if not actually being scared, Apple and Samsung are maybe sitting up and paying a little bit more attention to Nokia?
Yeah, well, I think where Nokia has really had success is in emerging markets, and that's a spot where Apple in particular has kind of struggled. They haven't got a lot of penetration in China, and Tim Cook's actually been over in China this week, had a meeting with China Mobile, really trying to expand their presence there. But it's going to be difficult when they're chasing the high end of the smartphone market. And Nokia, which has been more aggressive on the low end, more reasonably priced phones, has been doing well over there. And this could be the catalyst for continued mojo, I'm still pretty skeptical. It's a very difficult market to compete in, especially at the low end. But, hats off to them. It's a solid phone, the Lumia, and it's off to a good start.
James?
Well, when you're starving, Chris, even the worst food tastes good. And I'm looking at a graph, and unfortunately, I wish everyone listening could be here because it's hard to convey a graph on the radio. But if a graph from the Wall Street Journal showing Nokia's smartphone shipments from 2010 to present, they basically took a nosedive, like a roller coaster going down, and have now just barely blipped up. Now, a blip up is better than not. It's better than a continued dive. But, this could be good. I don't want to knock it, but I think we'll need a lot more to really kind of get our yanks going here in terms of excitement.
Charlie, to James's point, fortunately, when you look at the results from Nokia, it's not just I know the Lumia phones got the headline, but also their networking business seems like it's improving as well.
Right. The Nokia Siemens network joint venture was a huge anchor around their neck for many years. They've been restructuring that ever since Stephen Elop came on board, and profitability in that division will really help them out.
One other thing in the smartphone industry that I should mention that got some attention this week, the Wall Street Journal reported that Apple is working on a lower-end iPhone. Apple did not confirm that. They wouldn't comment on the story. And it was even written in such a way that said this is something that Apple's been kicking around for a few years, and they could still pull the plug on it. But if it happens, it's going to happen probably later this year. What do you think of that just as an idea, Joe? Is that a smart move for them, or should they just remain in the space they are?
Yeah, I think they should keep doing what they're doing now, which is focusing on making the best phone possible. I think when you start going down market, you're kind of diluting the brand and what it stands for, not to mention you're hurting margins. And, I don't know that Apple has a lot to gain in terms of accelerating price competition. Ultimately, that's going to come back to hurt them.
I think what they're worried about by making a more affordable phone is the market share losses to Android. And instead of focusing on the profitability of like an iPhone 5, they're worried that their ecosystem as a whole is not as valuable if they're not getting as many people in the door.
Yeah.
And so maybe this is a way to do that, but they have to. It's a fine line to walk to not cannibalize where they make their money on the iPhone 5.
Right, because the ecosystem, I completely agree, but the trouble is the ecosystem is what sells the phone, right? And if they make their money selling the phone, it's a difficult victory there when you're chasing the low end.
Just to bring it back to Nokia, Charlie, when you look at the stock, it's also to refer back to James's graph, and nothing says great radio like a graph.
It's blue with bars.
Nokia's stock really has taken something of a nosedive over the last couple of years, but you look at it bouncing off of its lows, it's more than doubled off of its lows so far. What do you think of the valuation of the stock right now? And if you are hearing this news and thinking about Nokia, what is the next thing you should be watching?
I think it's a good buy here. I do own the shares myself. And what you have to watch for is the next generation phone that they're going to launch and how that stacks up to what Apple's going to come out with later this year and what Samsung's going to come out with later this year. And you want to make sure they are at least competitive and they can keep the momentum going that they've built up so far.
9 months ago, Ford Motor started paying a dividend after taking more than 5 years off from paying a dividend. This week, Ford announced it's doubling the quarterly dividend, James, from 5 cents to 10 cents. I guess you could look at it as it's just a nickel, or you could look at it as, hey, it's 100% more.
Well, Chris, it's yielding roughly 3% now. So that's pretty good. And as a dividend investor, I actually might be interested if Ford made something other than American cars. To channel, I'm kidding, but it's actually, there's a really good story here. To channel Ron Gross, who is sick with the flu today, Ford is really firing on all cylinders, and it's doing it without the help of a bailout, which is kind of, I guess an analogy might be if you're running a race with another kid and he gets tired and his dad picks him up and drives him along next to you and loads him up with Gatorade and then drops him off, you're still kind of winning the race. So Ford must feel really good, but it's a frustrating good in a weird sense. But yeah, they're at a 52-week high. They hired, I think, 8,100 employees this year, another 2,000 to go. So a lot of good for this company. And it's kind of, I doubted Ford, but I'm regretting it. It's a lot better story than I realized.
What do you think, Joe?
Well, I think a lot of that is good. I don't think that, not being bailed out as a taxpayer, I certainly appreciate that. But they did issue a lot of shares to make that happen, and the balance sheet is pretty hairy these days. So I'm a little surprised that they're pushing forward with the dividend like that. And, it's a cyclical business. You got a lot of debt. I think the dividend they had was just fine.
Charlie, when you look at dividend increases in general, whether it's Ford or just any company, how do you view those as an investor? Is it automatically a good thing, or is it? I guess some could look at this in Ford's case and say, you know what, they wouldn't be doubling the dividend unless they felt really good about their financial strength.
Or if they're just delusional, to Joe's point. A one-off dividend increase doesn't get me all that excited, but if you see a pattern of dividend increases over 5 or 10 years or even more, like some of the best blue chip companies in the world, I do think that's an indicator of financial strength.
Yeah, this is called the I'm not dead dividend increase. Basically, Ford knows that people will think if they raise their dividend, Ford must not be dead. Ford must have life left. So they're trying to capitalize on that regardless of the finances.
Coming up, the holiday retail numbers are starting to come in, and for some companies, the news ain't pretty. More after this. You're listening to Motley Fool Money. Welcome back to Motley Fool Money. Chris Hill here in the studio with Joe Magyer, James Early, and Charly Travers. On Friday, guys, the FAA formally opened a full review of the new Boeing 787 Dreamliner jet. There have been several incidences in just the past few months, including one earlier this week that caught on fire on the ground at Boston's Logan Airport. Joe, I guess the headline risk sort of outweighs the actual risk, but this just seems like one of those things where when I look at the news and I look at Boeing stock only down a couple percent, still within shouting distance of a 52-week high, I'm just a little surprised that Boeing is not trading lower.
Yeah, well, behold the power of low expectations. In this case, it helps to kind of look through the numbers a little bit. So only about half of Boeing's total revenue comes from commercial airlines. The rest of it's related to defense. And within commercial airplanes, they've also got all the other 747 and less dreamy liners that they have, aftermarket parts and whatnot. And so it's a more diverse business than just the Dreamliner. I mean, whereas if you look at a Nokia, there's quite a bit more hanging on the life of, say, the Lumia phone. Obviously, they need the Dreamliner to work out. They've invested many billions of dollars. The plus side is there's huge demand for it. People are waiting for this plane because it can go farther, burns less fuel. So airlines are excited. Burns other things.
I was going to say, not when it's on fire. Charlie, what do you think?
I think the stock's holding up so well because it's not like there's a million other companies in the world that can build commercial aircraft.
Yeah.
It's like Airbus, Boeing, Embraer, and that's about it.
Yeah.
So they'll have to work out these kinks, but it's kind of like, it's our game and we're going to play it.
It's ironic. The plane itself was 3.5 years late to production, if I recall, and now it catches fire. But you're right. What else are they going to do? And these are electrical and I think battery-related things. They can probably, compared to the whole cost of the plane, the fixing costs, I imagine, are not as expensive as we would think. Or maybe I'm wrong.
So on the flip side, Joe, if they come out of this FAA inquiry with a clean bill of health, does that mean that on the upside there's going to be very little in the way that we're going to see the stock boosted?
I am not actually all that worried about the FAA thing. I'm more concerned about their ability to just fix all these problems. And if they can do that, I think the next few years are going to be very good to them.
Some bricks and mortar retailers had a tough end to 2012, but Best Buy apparently was not one of them. Shares of Best Buy up more than 10% on Friday after reporting that same-store sales during the holiday season were flat. So, Charlie, if I'm doing the math here, flat comps means awesome news, apparently.
Yeah, when you're Best Buy, it does. I mean, considering that they're competing with Amazon and Target and Walmart, consumer electronics has not been a good place to be for bricks and mortar retailers in recent years. And they cite that, better employee training to help people out with their decision making and price matching online, which is key because these have been long a showroom for people to come and see $600 TV and then buy it cheaper online. But they've decided to match prices and keep those sales at the expense of margin. But I don't really see long-term optimism here for Best Buy. I think the competitive environment is not in their favor.
We also saw Target earlier in the week coming out with a similar. They had an online price matching program that they had set up in October. They came out this week and said, "Hey, we're just going to extend that through the end of the year." What do you think of that, Joe? Because it seems like Target's doing well on its own, and this seems like almost like they're baiting Amazon.
Yeah, it's a little gimmicky. I mean, Target cannot win a price war with Amazon over the long term, and they know that. And what's funny is when you look into the fine print with this offer, it doesn't apply to third-party sellers on Amazon. Well, 40% of the volume on Amazon is third-party sellers, so 40% of the people who show up and try and claim this are going to get stiff-armed, and I'm sure they're not going to appreciate that.
We're going to see more results as more retailers come out with sales figures and obviously earnings for the quarter as well. But, you know, it was not great news in general for retailers this week. We saw apparel retailers like Aeropostale coming out and cutting their guidance, and even Tiffany, which has been doing well of late, their sales came in at the low end of the quarter. What do you make of this, James, when you see, on average, more retailers than not that are struggling in the holiday season, which is so crucial for so many of them?
Well, a lot of this stuff is not the most necessary retail in the first place, and that's going to be showing more softness right now. I think our retail has been saturated. I think we're seeing the results of probably a decade plus long mega trend, Chris, versus a quarterly issue. I think we have just so much retail, and the pullback is just more indicative of people's decisions. Consumer spending is 2/3 of the economy, so it's not really surprising. I feel it's a good sign, actually.
How do you guys differentiate between a retailer that is in trouble, that is genuinely struggling, and, to James's point, just sort of like a quarterly blip, just sort of this whole notion of like, oh, look, they just had a little bit of a hiccup, and instead of them being in trouble, the stock is just on sale?
I kind of go like this. Are they eBay or Amazon? Yes? Then they're not in trouble. Are they not? Oh, well, then they might have some issues. And there are a couple exceptions to that. Costco, I think, being the all-star membership model, great customer service, great prices. But, for the most part, brick-and-mortar retailers are just really going to struggle to compete with online, which offers better price transparency and better selection.
The other exception I'll make is companies with phenomenal brands that can transplant them overseas and avoid some of the saturation issues domestically that James was talking about. If you think of companies like Starbucks or Coach or Yum Brands that are going into Asia and Latin America and doing very well down there.
Retail is like a radio show marketer. You have these, like, the cool radio channel doesn't last very long. There's something else after a year or two. Once the market turns on you, it's a tough business.
Yep.
We got about a minute left. After 4 years as Secretary of the U.S. Treasury, Tim Geithner is stepping down, and in his place, President Obama has nominated White House Chief of Staff Jack Lew to be the new Treasury Secretary. What's most distinctive about Jack Lew, he does have business experience. He was an executive at Citigroup. But what's getting all the headlines, James, is his signature.
What a relief.
Yeah. Hopefully he'll bring that great city experience over. His signature is getting all the headlines. It's this series of loops. You're sort of an amateur evaluator of signatures. What
It
do
is
you make of
fascinating,
this?
Chris. High school, I got really into graphology, which is the science, if you can call it a science. It's not really a science, of analyzing handwriting, and I would analyze all my friends' signatures. And there are some people, there's a certain body of evidence in graphology that says that loopy sort of notions are indicative of sexual deviancy. Now, this is not I'm not diagnosing anything I don't know. I'm just representing that news here. But it is certainly a very interesting signature, Chris.
It looks like your pen's not working and you're just squiggling it around on the paper to get it to work, and that's what his signature looks like.
Hopefully, by the time he becomes secretary and his signature is actually on the currency, that'll get cleaned up. Joe Magyer, Charly Travers, James Early. Guys, thanks. We'll see you later in the show. Up next, we head to Las Vegas for a report on the Consumer Electronics Show. Stay right here. This is Motley Fool Money. As always, people on the program may have interest in the stocks they talk about, and the Motley Fool may have formal recommendations for or against, so don't buy or sell stocks based solely on what you hear. I'm Chris Hill. Joining me in studio, once again, Joe Magyer, James Early, and Charly Travers. Before we get to the stocks on our radar, just talking to Rob Pegararo at the Consumer Electronics Show, and Charly, there are so many gadgets out there, and one of the things I mentioned to Rob, the one that sort of blew my mind was this company NeuroSky, which has the miniature helicopters that you control with your mind, which frankly seems like something out of a James Bond movie. But you know what? If the price were right, I would probably pay for one of those.
I would terrorize my cat with that.
But you're something of a gadget guy. What coming out of CES, sort of what stands out to you?
Well, as a gamer who loves my Xbox, the Microsoft demo in the middle of the Samsung keynote presentation was quite amazing. The current Xbox is 7 years old, so the next generation one is coming out very quickly. And what they're using is their Kinect technology to scan your living room, and then using Samsung's projectors to take your game, and you're basically blowing out your TV LED to the entire wall. So if you imagine you're gaming, they showed snow falling on your wall or explosions and fire. It was incredible to watch. Go look it up.
That sounds awesome. It also sounds like you could really mess up a little kid with something like that.
Yeah, or my cat.
Or your cat. Let's bring in our man Steve Broido from the other side of the glass. Steve, before we get to the stocks, any gadgets from CES that look good to you, or anything on your wish list? Because they got thousands of companies working on gadgets.
See, I'm going to go off the board and go with a gadget that goes on your keychain, and it's totally not technological at all, but it has saved me in many ways. Whenever I need a pen, it's called the TelePen, telescoping keychain pen. I have a photo up so you can see. It's this little expanding pen, and it goes on your key ring every time you need to sign a check or write something down. I always have a pen with me. It's not like electronic, but boy, do I love that little pen.
I thought you were going to say a bottle opener.
No. The TelePen telescoping keychain pen. Google it. It's very inexpensive. It'll change your life.
I don't think I've ever heard you promote something in quite this way before. Is it possible you're an angel investor in this company?
I wish. Believe me, I wish. I love this thing.
Are you getting a little cut? Are you getting a promotional deal?
Believe me, I wish.
Promotional consideration for Mr. Broido's wardrobe, paid for by. Let's get to the stocks that are on our radar, and Steve will have a question for you. Charly Travers, you are up first. What is the stock on your radar this week?
I am very excited about Baidu. Ticker is BIDU. The stock has sold off pretty hard recently, started to rebound. They are the equivalent of Google in China. They dominate the market just like Google dominates search here. All the same competitive advantages. And I think this is a long-term winner as the internet and e-commerce just continues to grow in China. It's a phenomenal buy right here.
Is part of the reason you're excited about it the valuation, because it has been sold off so much?
Right. This is a stock that has seen its revenues just explode, and it's priced for about 10 or 12% growth right now. It's really on sale.
Steve, question about Baidu?
Yes. What is its relationship with Google? Is there one? And second question, is Google, did they pull out of China entirely? Are they back there? What happened with that?
Yeah, Google did back out of China. I think they're still operating in Hong Kong. Now, Baidu does use the Android operating system on some mobile devices, so there is some connection there.
James Early?
Chris, I am going with Bank of America. The ticker is BAC. This is on my radar, not necessarily in a good way, although I am a customer. These guys were basically two clowns short of a circus coming out of the bailout. It was just one goof up after another. And with this interest margin issue, I see more clouds looming overhead. They're in the middle of settling these mortgage fraud issues, but it's not quite done yet to the extent people think. So I think the clown fest will continue.
I was going to say, the big story at the beginning of the week was Bank of America settling for more than $10 billion with Fannie Mae. That was greeted by the market as good news, but you're still looking for more
now
clowns.
It's being questioned by some watchdog group or something, and there's still some more settlements, smaller ones albeit, but more settlements to be done.
Steve, question about Bank of America?
Do you recommend owning stocks that of companies that you believe to be kind of slimy?
Well,
I don't mean that as a joke.
I'll answer it like this. I see what you're asking. You can, but you have to sell more quickly. So in other words, a slimy company that's selling for really low valuation could actually be a good investment, but you want to sell that once it hits your valuation estimate. You don't want to keep holding that kind of company for the long term.
But ethically, do you think it's a good idea to own a stock in a company that you believe maybe isn't the most
that's
wonderful?
Not how I roll, Steve. I mean, I realize that other people do that, but personally, I wouldn't do that.
I do.
Do you have a company in mind that you're considering that is some slimy? And that's
I've owned Bank of America in the past. I don't own it now, but it just, I don't know. They kind of creep me out. I mean, it's a big bank. I have a feeling there's a lot of people doing some bad things there.
I don't know if I term them slimy, but I understand what you're saying. Yeah,
Maybe poorly run. Yeah.
Joe Magyer?
I'll go with automatic data processing. It's the nation's largest payroll processor. Stocks aren't cheap right now. The market's near a 5-year high, so it would behoove people to think about how they're diversified. And if you're looking for something conservative right now, I think ADP is a good fit. It's one of the few companies with a AAA credit rating. I think there are 4 left, and they're one of them. Nice, rock-solid dividend, and it should do well as the economy bounces back. You get better employment numbers. And when interest rates go up, too, they'll profit.
Before I kick it to Steve, we were talking earlier about Boeing, and Charlie made the point about essentially barrier to entry. It's not like you can just throw up a company that overnight that makes jets. To what extent is ADP in that category where they have a high barrier to entry?
Well, the nice thing is they compete at the high end of the market in terms of the size of their customers. So if you wanted to handle all of payroll for Ford, for example, or JP Morgan, it would be incredibly difficult for you to step in and do that because you've got to deal with all the complexities of, local, state, municipalities, that kind of thing. So it's a very strong business with incredibly high retention rates because of that.
Plus math. You got to do a lot of math if you're
Yeah.
in that business. Steve, question on ADP?
The question is, what percentage of the market does Paychex currently have, if you had to guess?
It's substantially smaller. It's tough to get breakouts from them, but ADP processes around like 1 in 5, 1 in 6 U.S. payroll checks, and Paychex is the next step down from them. So pretty small in the grand scheme of things.
Paychex is more like the small to middle-sized firms. ADP is kind of the mid to bigger, and they kind of leave each other alone.
Yeah, it's working well for them.
Steve, Baidu, ADP, Bank of America, you got one you like?
I'm going with Joe's pick.
Yeah.
We will end there. Joe Magyer, Charly Travers, James Early. Guys, thanks for being here.
Thanks.
Chris.
That is it for this edition of Motley Fool Money. Our engineer is Steve Broido. Our producer is Matt Greer. I'm Chris Hill. Thanks for listening. We'll see you next week.